It's time for Money Tuesday, and we continue to be on your side with financial advice on what you need to do and what you need to get in order before you can retire comfortably. Marshall Clay with the Wealth Group joins us this morning. Again, this is part two. We're focusing now on portfolio construction for those of you who have retirement portfolios, and also what strategies you need to make as you get closer to retirement. We're talking about 2 years, probably close to retirement and into retirement, right?
Exactly. At least probably 2 to 3 years of retirement. But I think, we talked about those psychological challenges, and I think what happens as you get closer to retirement, there's some portfolio management issues that creep in as well. And I think you and I were talking just before we came on the air about, look, when you're working, you've got income coming in. So if you make a mistake in your portfolio, it's not as present for you because you still have that job. But once you retire and you move away from that, you're fully reliant on that portfolio. So if you make any big mistakes, it could really cause you to have to change lifestyle.
So how should you approach this? Well, I mean, obviously it would help if you sought a fiduciary to get some advice, but some people may want to do this on their own, not have to do that. What would you tell them?
So I think if you're heavily weighted towards stocks, you definitely want to make a shift and focus a little bit more on the bond and the fixed income market. That's going to be the stable, the safety net portion of your portfolio. You want to have a minimum of 3 years. Ideally, we like to tell our clients to get up to around 10 years of that safe, secure income in bonds, fixed income, and cash. Okay. And I think right now, there's some very appealing rates in the money market mutual fund arena, short-term bonds that investors can look at. But I think when you're talking about the stock side, I think you want to shift away. You don't want to completely abandon the growth type companies, but you want to shift more towards companies that have proven business models. These are companies that are making money year in, year out, ideally paying dividends and have a great history of paying dividends. So if you can't get into looking at individual companies, there's a number of ETFs and mutual funds that focus exclusively on those type of companies. So if you don't want to get into individual stock portfolio, I'd do that. But the key is just understanding what you own, develop that buy and sell side discipline so you understand what you're owning and why you own it, particularly in retirement.
And again, we realize not everybody has a 401k or whatnot, but if you do, and you're getting close to that age, this is important to reconsider because some people they put it in there when they're younger. Money's going in, they don't worry about it. But when the market dips, if you're close to retirement, obviously you mentioned earlier that could have a huge hit. So in terms of rebalancing and the strategies you should take into retirement, you really should watch that, right? You actually need to do the work yourself or hire somebody. Right?
Yeah, absolutely. A lot of the 401k programs will give some sort of automatic rebalancing option. I think when you move away from that, it's now going to be on you to kind of go in and manage that dynamic. And I think another important aspect of all this, I've talked about this in the past, is understanding the taxation of all these accounts, right? You've typically got your pre-tax, you got your 401ks, you got your IRAs. Some people, if they're fortunate enough, have Roth IRAs. And then if you're really fortunate, you have wealth accumulated into these after-tax brokerage accounts. And I think one huge mistake that I see people making is they're pulling money out of the wrong accounts. It's causing them to pay more in federal income tax. And then I think certainly when you get over 65, which hopefully all of us will one day, those income tax brackets can actually affect how much you're paying in Medicare. So it's very important not only with the portfolio management piece, but also understanding how you're getting that money out because it can affect not only federal income tax, but also Medicare.
And we've done segments on that before. We'll revisit those again because when you take Social Security can also impact what happens there, especially if you have two people, you're married to somebody and you're both getting Social Security. Marshall Clay with the Wealth Group, thank you so much. We appreciate it.
You're welcome.
All right, we'll be right back.
Southern Life